Thank you so much, everybody, for joining us. Welcome to Spotting Common Reimbursement Mistakes, Pairing People and Programs. Again, thanks for taking the time out of your schedules to attend. We're really excited to be sharing some best practices with you on how to manage your vehicle programs for success and for successful outcomes. So a lot of the time when people come to us, they ask our, they're asking our team, they're asking our specialists the question, is our program correct? Are we pairing people to mileage reimbursements in the right way? Are we managing it effectively? Are we paying people too much or too little? And how do we know? So today we're going to be discussing how to implement and manage policy that helps you avoid pesky reimbursement mistakes and keep your employees happy, keep your burden low, and your tax compliance intact. So the name of the game here is about understanding the intersection between your program and how you build it. So your FAVR reimbursement, your mileage reimbursement, something in between, and your tax compliance, and ultimately your company's ROI, to effectively really build something and manage programs that really meet your employees' needs and effectively mirror the behavior to ensure fairness and attractive benefits for everybody involved. Again, as was mentioned in the chat, we're going to be doing some questions at the end, but if anything ever comes up, feel free to put that in the Q&A and we'll answer these at the end of the session. So just as a reminder and to preface for everybody here, vehicle and mileage reimbursement is the concept of enabling employees to drive for work by paying appropriately for their business expenses. More on this in a bit, but just for some quick introductions and to preface our conversation today, Griffen and I are coming to you from Cardata. So Cardata is the fully managed vehicle reimbursement partner that works with companies to design and scale and optimize their vehicle and mileage programs. So we essentially use data and software, expert services to reimburse drivers on the road fairly and tax-free. Of course, in the way that makes the most sense given their needs and within your policy. So since 1999, for over 25 years, we've been working with companies in a large range of industries with field sales and service representatives and have captured over 1 billion miles to date and reimbursed over $900 million. As for myself, I'm the senior manager of product marketing at Cardata. I spend my days for over 2 years now connecting with customers, prospective customers alike to really consult on best practices for vehicle reimbursement. I am very lucky to be joined by Griffen. I'll pass it off to her to introduce herself.
Good afternoon, everyone. Thank you so much for joining us. As Lee mentioned, my name is Griffen. I work in business development here at Cardata. So I'm typically the first point of contact, often speaking with potential partners on the phone or via email. So looking at some of the key points that we're going to be covering today. So we're going to be looking at how to build a reimbursement program that meets your employees' unique needs, how to avoid tax exposure and audit risk by choosing the right program and managing it effectively, how to measure a successful vehicle program using KPIs or key performance indicators, how to leverage industry data to benchmark annual rates and meet your budget and benefit goals, and then finally, how to use a partnership approach to reduce the internal administrative burden that your team is facing and ensure that you have fairness for your employees. Perfect. So to hit on each of these points, we're going to flow through the following topics. So we're going to start by looking at the most common reimbursement and vehicle program blunders, followed by the risks of these pitfalls. So this include tax risk, over expenditure, audit risk, and employee dissatisfaction. Then we'll look at what is vehicle reimbursement. So this has definitely changed over time. How does it look as we head into 2025? Next up, we're going to talk about matching employees to the appropriate reimbursement option for their vehicle use and company goals. We're going to look at how to leverage your program partner to help you and help build this out. And then finally, we're going to discuss signs that it may be time to reevaluate your program and potentially your program partner.
Awesome. All right. So as a quick reminder for the folks on the call, most of us here have pursued reimbursement and the reimbursement model as a replacement for one of these outdated approaches. So every single company functions differently, but there are a range of commonly outdated programs that are being used in the space. So that includes things like risky company cars, which typically are 25% more expensive than their reimbursement alternatives, with all things being considered equal. You have things like taxable car allowances, which waste over 37% in tax across FICA and income taxes and are often unfair to drivers as they don't really take into account real need. And they often leave employees with 30% less in their pockets due to tax. And of course, there's people who are still doing manual mileage submissions or ad hoc expense payments that are very time consuming, and they actually waste on average a full week of work per year, right? So a lot of challenges here, but the main problems here are the lack of accountability and improper cost allocation that are associated with these options. Meaning, it is often unclear whether the cost of the program is justified by its use. So, is what you're spending on your drivers actually going to required cost and required need? And whether its use is justified and properly allocated to cost. So, are you spending enough, too much, too little, and how do you know? So, the results of this are often corporate liability, risk over underspending, equity and turnover, upset people, right? And often, people aren't benchmarking decisions. They're not using data to make choices, not to mention the immense tax waste. So because of this, people are turning to well-managed vehicle reimbursement models.
Perfect. So, as we know, not all programs and partners operate the same way and have the same priorities. So, the narratives we hear from customers switching to Cardata from alternative program partners are fairly consistent. The largest issue we see is typically administrative burden. This is followed by high and increasing cost. So, I think the cost piece is an important one because there can be valid reasons for increasing costs to maintain a fair reimbursement. It's just important to understand the why behind cost changes and understand how it adds value to your program, differentiating those necessary program additions as well from upsell. So we hear about poor customer support as well, unnecessary tax waste, often due to a lack of program updates, unfair payments to your drivers, and then finally corporate liability. Customer support is key to keeping your drivers happy and the burden of your program low, especially on your internal administration team. And a key part of this is ensuring that they have access to reliable and responsive customer support team from the vendor directly. So our goal is to provide actionable solutions and tools to stop these pain points. So Lee, there are two areas that are often sticking points for reimbursement program management. They stem from not understanding IRS regulations and not knowing how big of a role you need to play in your program. Can you tell me some more about these issues?
Yeah, of course. So I think this is really important to discuss. And a lot of these misconceptions are not the fault of the people who are running the programs, but simply perhaps a symptom of something that has been sold previously. So the first element that really causes mistakes and ultimately challenges with the reimbursement is thinking that the program is a product. It's not. It's a strategy, right? So you might think, okay, well, I bought a mileage tracking app. I should be good, right? Or I have an expense management tool, or I bought a FAVR program. But it doesn't really work that way, right? It's a process. It's managed. And so you might have purchased the program with the intent that certain employees will be enrolled in it, but does that still make sense for them? Does it meet their current needs and their current behavior? The other thing that we often see is people thinking that their program is stagnant. Well, it can't be stagnant. It's a living and breathing entity and needs to mirror real market data. And it requires some upkeep to maintain compliance, of course, in line with goals and also in line with CRA or IRS regulations. Now, the other element that we see is people might not understand how their rates are built or managed. And that's okay. It's perfectly fine not to be an expert. And that is simply your partner's job, right? That would be the job of Cardata. But if there's confusion about the how and the why behind rates, then you're the one who has to listen to your drivers who are confused and don't understand if their rates are fair. And that leads, of course, to buy-in challenges. So all of this coming together is really how there's some risks of not understanding reimbursement regulations and the role of your partner. And of course, this often results in not knowing what role you should play in your reimbursement program. So you might know too little, meaning you can't really effectively enable your drivers, and your partners aren't helping you do that. Or you might be doing too much, or you know everything, and there's a lack of support, right? And there really should be a middle ground. So we're going to be going through a lot today. Some of this, some of you on the call might understand really, really well, and some of these more complex points might be completely new, and that's okay. We in no way believe that you should be a reimbursement expert. That is what we are here for. But I hope that you can take away some learnings about how to avoid some risks and avoid some of these mistakes to ensure that your benefits are fair and appropriate, and that you're also getting the bang for your buck in all aspects of your reimbursement program by pairing people to the right tax-free programs.
So Lee, what are the implications of these risks if mistakes are made?
Yeah, it's quite common that we'll see some of these things come up. Tax exposure is very, very common. That's one of the ways that we often see this problem getting awoken is that a person might say, "Oh, shoot, I noticed that my program's actually not getting me the tax-free benefit that I wanted." Because of course the IRS requires some tax regulation regardless of the program that you're using, particularly for FAVR. Um, Also that results in things like lack of buy-in, right? If there's no buy-in, if people aren't using the tools correctly, they're not capturing their mileage, they're not submitting their insurance, then that also exacerbates the tax exposure, which ultimately creates the lack of ROI. So it's all very connected, right? And if you're not pairing people to appropriate tooling, then you're never going to see that benefit, right? You're never going to see those happy employees. You're never going to see that financial benefit. And then ultimately, these are quite common. But in your experience, Griffen, which of these seem the most familiar?
I would say, in the end of the day, quite frankly, they all do. We've had over 40 companies in the past year or so transition to Cardata from alternative reimbursement providers. These are definitely the common symptoms we hear of poorly supported programs, rather, and definitely things I hear day in and day out, on the phone.
Yeah, so true. Now, let's just talk a minute about the context in which we're operating today. Compliance and equity risks are a growing concern for companies of all sizes. So perception is reality, right? And the perception of fair pay impacts intent to leave. People are 49% more likely to leave their jobs in the near term if they perceive their compensation or their benefit to be unfair. Workforce related issues related to talent management is a huge priority, a huge strategic priority. It has been from 2022, 2023, and into 2024. So when it comes to people who are using personal vehicles for work, their perception on whether they're getting what they need matters. They need to feel as though they're being treated and compensated fairly for their actions. Otherwise, they're going to really go to a place that does do that for them. So I want to talk a little bit about why does it matter if you do reimbursement right? Right? Oh, I could just reimburse anything, right? Why does it matter? And apart from the fairness element, the fairness that reflects employee satisfaction and cost efficiencies, and the element of taxation, of course, which are all pieces to consider. Let's talk about, from the perspective of the IRS, what differentiates reimbursement from compensation. And essentially, reimbursement covers costs directly related to company required work. And so, unlike compensation, it's not considered income, right? It's not a reward for doing something extra special. It's directly related to job related requirements. So, as long as it complies with IRS standards within the US or the CRA in Canada, a reimbursement that's necessary for work is not seen as additional pay. It's perceived differently, and therefore it doesn't need to be taxed. So think about your reimbursement program as the formal receipt for the cost that it covers. And with that being said, even though it is a tax-free, well-designed reimbursement program, it offers for a lot of companies a way to give a really strategic, attractive tax-free benefit to employees. Because if you use market data and you use industry standards, you can tailor this reimbursement to effectively enhance overall comp packages. So in this next section, now we're going to talk about what are the optimized tax-free reimbursement options, and then how do you know that that's right for each of your team members? So first, we're going to review IRS-approved reimbursement types. Then we're going to define and match favor to drivers. We're going to talk about building rates, and then finally, compliance regulations. Now, most companies, including Cardata, offer 3 IRS compliant tax-free vehicle reimbursement program or VRP options, depending on a partner's specific needs and their driver's habits. So this is where matching is going to be really, really important. And we're going to go piece by piece to kind of put the puzzle together. So again, every company is going to be different: territory sizes, goals, site locations, metrics that you're measuring. So all this needs to be taken into account. There's never one size fits all. But the best way to appropriately support the ROI on your program and your employee satisfaction is to select and effectively manage a program or a group of programs that are best suited for your outcome goals and your employees' behaviors. And we're going to be sharing some tips today on how to decipher this. But starting on the left side here, we have cents per mile. So this is really best suited for low mileage, occasional drivers, and tax-free uncaptured business mileage. Second, we have tax-free or accountable car allowance, which can support a payment in being up to 100% tax-free using something called Publication 463. I know, very exciting. More on this later. And the most common vehicle reimbursement approach is FAVR, fixed and variable rate reimbursement, which, when done correctly, is 100% tax-free and leverages up-to-date cost data. Each program, every program you see here, requires effective business mileage reporting and accountability in order to be tax-free and adhere to policy. Let's get into them. Okay, starting with cents per mile, otherwise known as basic mileage reimbursement. This means pairing a driver's submitted mileage directly to a basic per mile rate. Most of us on the call have done this, most likely, in the past, if you've ever visited a client or ever done a work run. So a driver might submit mileage. Every mile is then multiplied by a per mile rate, done, very easy. So this strategy is really ideal for an occasional driver or someone who just hops in their car once in a while to visit a customer or run like a work errand, for example. Why? Well, cents per mile is best suited for those who are driving under 5,000 miles per year, okay? This would be considered low mileage or casual drivers for all intents and purposes under the guidance of the IRS and how their publications can be navigated, okay? So that's really how you pair effectively this program to mileage. That's because most companies who use this approach also use the IRS standard mileage rate, which in 2024 is 67 cents per mile. It's really typically updated annually. What that means is the IRS has essentially said, okay, United States, the national average cost of driving across America is 67 cents per mile. That's average New York, California, everywhere for that time period. And companies can then pay up to this rate per mile and be permitted to pay no tax on this exchange. Okay, so really this is best suited for an occasional casual driver. It's really quite simple. It really packs in every potential cost they could be putting on their vehicle across fuel and depreciation. It does very, very much average that out across the states. And when pairing this per mile strategy with effective reporting tools and simple mileage capture methods, reimbursements can be 100% tax-free, and there's really no laborious effort for your drivers on the road if they're using things like a mileage capture app. Now, when we creep over that 5,000 mile mark and we start to see what we consider high mileage, the ROI, the fairness, and the fit of this approach becomes a little bit more questionable. Now, the IRS standard rate doesn't take into account the frequent fluctuations of living costs, such as maintenance and fuel in different specific regions. It's not geographically sensitive. It doesn't take into account the impacts of things like depreciation. So as you drive more, there's no element to consider how much you drive. It's not tiered by mileage bands by any sense. So it's really just that. It's just a national average. This means that some drivers will get way more than they need as they rack up mileage. Some people I've seen take home like $46,000 a year in cents per mile reimbursement when they're using the IRS standard rate. And others might take home way less than they need because the costs of their area are so high. So that's the challenge with this rate. It's great. It's very well calculated for the occasional driver, but for our daily road warriors, the people who are driving all the time, field sales and field service representatives, it really does over and under deliver because it's not really designed to be used in every situation. And that's why different options exist. So let's talk about it. All right, the star of the show, the most common approach for those in the room today, most likely using a provider to facilitate your reimbursement. Most of your drivers, the hunk of your population is most likely on FAVR. So you'll probably know that FAVR stands for fixed and variable reimbursement. So this is a strategy for reimbursement that leverages regional and vehicle-specific information that influences a person's driving expenses. And then it reimburses the business portion of those costs relative to real-life cost conditions and employee driving frequency. It does so using a combination of an allowance payment and a per mile method. FAVR is actually the most common approach for high mileage drivers using personal vehicles, as it's widely considered the most fair for the employee and the employer. Why? Well, as I mentioned a couple times in this presentation, and I'll echo again, the data-driven nature of this method really leverages cost databases and database technology to effectively build payment rates for each employees relative to the real cost of driving in their location, right in their zip code, and based on the actual requirements of their job. And because of this, Favor has the ability to be tax-free regardless of the IRS standard rate. And yes, that means, of course, paying above the IRS standard rate equivalent, if that makes sense, or below, right? It's all about fit. It's all about fairness. And in that way, really, this is the receipt to the IRS. Because they're using so much data to build the rate, there is no income and there is no tax associated rather with the transaction. So let's learn a little bit more about Favor and the nuances of Favor and how to know who should be on Favor. Now, Favor rates are built off a general vehicle profile. You might hear that being said. You might also hear standard vehicle or base vehicle model. Really what this means is it's the type of vehicle required to do the job as determined by the company. So the company will say, okay, if I'm a field rep, I need, a mid-size sedan. Great. Or I need a mid-size SUV, or I need a rig truck, whatever you need. And essentially, once that's defined and we're really clear about the requirements of the job, employees are then reimbursed based on these standard vehicle costs right in their location. And that payment's broken down into two parts. So you have the fixed payment. Think of this like a monthly car allowance, which includes the business use percentage of car ownership costs. So things like depreciation, insurance, license and registration, taxes. Business use percentage, everybody could, you might be different today, but typically what we see is 71.4% to 75%. 71.4% is very common because companies will assume that their people drive 5 days of the week for business and the other two are, in change for personal. But the IRS actually will allow you to reimburse 75% of a vehicle cost for business. And then on the variable side, the variable payments really just applied on a per mile basis, very similar to cents per mile, right? You submit mileage, you get paid on that mileage, and it covers the operating expenses as they're incurred. So as you drive, you might have different costs than you had yesterday because you've now driven your vehicle, right? You've now put mileage on it. And that, of course, depends on the driver and their location. So think about fuel, tires, and maintenance. And of course, this is typically updated monthly using daily averages. And let's look at an example of that. So this is what a favor rate looks like. Again, most people on the call understand this. However, let's talk about how to build the rate and how it works in the back end. So step one is really to input your driver's zip code and address data. So in this example, I used Vegas as my city. Now, step two is to select the vehicle profile in which I will calculate the reimbursement for Favor. So what is the basic type of car somebody would need in order to get their job done? What type of car do I want to use for this reimbursement? What cost data do I want to put into the data set that's going to give me a number on what it costs to drive, right? And then how much does it cost to purchase that car? All of that information is calculated on the back end. Then we just need to edit the details. So I can choose things like my vehicle's retention cycle. So how old is that car? The age, the driver's business use percentage, as I mentioned before. So do I want to reimburse 75% of their total cost or 71.4, somewhere in between, right? You make those choices. Of course, you're going to want to work with your vehicle reimbursement program expert to balance driver compliance with of course, desired outcomes. I mentioned the 5,000 mile regulation. We'll talk about a couple more in a bit. And then, of course, you're going to adjust your inputs according to your goals. Of course, you're also going to want to make sure that you choose insurance regulations appropriately. The most common that we see is 100, 300. But again, every organization is going to be a little bit different. And then rates are created. Now, I will note that the market reimbursement database can really create billions of combinations relative to data and based on the decisions that you choose. And really every rate for every driver is going to look different depending on their zip code and their driving frequency and their needs. But it's important to remember that when you work with a provider that understands the complexities of what Favor can do, we're then able to leverage things like what your competitors are doing, what the industry standard is, and also leverage your goals and your historic compliance to be able to build something that's a little bit more scalable and is managed for success. Now, if you thought that Favor was, cut and dry, it's not, right? It's an art and a science. There is, millions of combinations that can occur that are based in data, and ways to create profiles that are compliant and that really make sense for your driver population. But you really have to understand what you have control over. And ultimately, things like the make and the model, right? If the reimbursement doesn't cover cost appropriately, you have to ask yourself, am I reimbursing on a model that is big enough? Is the trim level appropriate? Is the retention cycle short enough, right? Like really think about whether or not these inputs are actually mirroring what your drivers need. And then if you think you're inflated, right? Things like, is my retention cycle too short? Is my business use percentage too big? And making these decisions and being able to benchmark accordingly is something that your partner can help you do. And also, of course, remembering what you're asking from your employees when they're on the road for work, what their job incorporates. Now, of course, drivers are subject to compliance regulations to be eligible, to be 100% tax-free. It's important to stop here and talk about it because I think for a lot of people who originally joined FAVR, this perhaps was a little bit unclear about how this can come to life in certain programs and how they're managed effectively. Now, the most well-known FAVR regulation is associated with that mileage minimum. So I mentioned before that cents per mile is best suited for low mileage drivers, so under 5,000 miles. If they're not driving, more than that, probably makes sense for them to be on a program like this. FAVR, that 5,000 mile mark tends to be the indicator when you're pairing people in programs that program makes sense. Now, there's a couple other ones. One of the regulations I want to mention as well, of course, is a driver minimum of 5 drivers, but that because FAVR reimburses for the business use of insurance expenses, the driver's insurance must also be verified for appropriate coverage. Now, Cardata does that. Obviously, it's nice that your employees are safe on the road. It's great to know that they're causing no risk for the organization. But it also does remove the risk of hidden income that would exist if a driver's being reimbursed for coverage for insurance that they don't have, right? So that's why IRS really cares about that, is because they want to make sure that there's no hidden income, of course. Next, of course, the vehicle driven by the employee can't be older than the retention cycle chosen by the company. So if my cycle's, for my company is 5 years, and they're saying, okay, Lee, I'm going to reimburse you on a vehicle that's 5 years old, and I'm driving a, 2017 Honda Civic, but it's set on a 2024, I might now be out of FAVR compliance. Why? Well, same as the insurance rule, right? So FAVR reimburses for depreciation over a period of time. So if I'm driving a car that's deemed fully depreciated in the eyes of my program, why am I getting money every month to cover that? So again, that's why this rule exists. It's nice to peel back the layers and really explain some of these regulations to make people feel a little bit more comfortable with the rationale behind why all these regulations and policies might exist. And then finally, when new, the MSRP of a person's car has to be at least 90% of the standard vehicle cost on which the reimbursement is based. Why? Well, if you tell me I need a pickup truck to do my job, hypothetically, you say, okay, employee needs something similar to a pickup, and you reimburse me for the cost of a 2024 Ford F-150 limited, so that's pretty expensive, and I have a Nissan Versa sedan, then the IRS might say, whoa, 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 you don't incur any cost that's similar to driving a F-150, right? So that's where you might see some potential taxability. Now, I will note, of course, that it's really important that these programs be reviewed annually. And if your program is not being reviewed annually, please question that. Now, you don't always have to update it, but I do think it's really important to look at things, of course, like mileage band, but also the year in which you're reimbursing. So, of course, you have to make sure that your reimbursement is defensible and reflects the real cost of driving, which is something that we take very, very seriously. And of course, it's risky if audited if you're reimbursing on something that doesn't really reflect real cost. And we've also met a couple of people who didn't have commute regulations on their program, so they weren't deducting for commute, and that's personal under the eyes of the IRS. So all of these small tidbits that have to be considered, again, encouraging you to go to market and book a one-on-one review with us, and we can help you check things out to make sure that everything makes sense. Now, I want to take a deep breath because at this point you might be thinking, this seems like a lot of compliance regulations. I didn't know this. I didn't really know that this was the case in my current program. I'm scared. Don't be scared. Don't be scared. If you do find your drivers out of compliance, there's a very simple calculation that determines if there is any consequence for that. If, big emphasis on if, right? So this is how the math shakes out. Most of you know this, but I want to kind of walk through the IRS formula a little bit. So if you do fall out of compliance for any reason at all, age, cost of your vehicle, insurance. Now, it is up to the company to make decisions on whether that's acceptable, if they want to keep them in the program or not. And we're going to share some insights as well on what makes the most sense. Some people choose to withhold fixed reimbursements, for example, when they don't have their insurance in place or they just take them off the road. Great idea. But again, from a taxability perspective, this is what happens. All we do as a partner and as the IRS is we look at the difference between what your driver actually took home under their FAVR reimbursement and compare it to what they would have taken home at their mileage if they had used the IRS standard rate. So that's 67 cents per mile. And they're only taxed on the difference, okay? They're only taxed on the difference because that difference would be seen as unsubstantiated income because you've fallen out of FAVR compliance. You've no longer proven to the IRS that you deserve to be in FAVR because you've done something that echoes the fact that your cost might not look like that. That's okay. You've still eroded your tax bill because you've captured mileage and you effectively compared it to the IRS standard rate. I will note that the taxable amount is not the tax owed. That's just the amount of money that you would then be taxed on, of course, relative to the driver's tax bracket. And of course, this is also done at Cardata. So there's really no labor that has to be done from a partner perspective for you to be able to execute this. And if at any point you want to see compliance status for your drivers, you can open up your system, whether you're using us or an alternative provider, and really look at the net statuses of your team. I will also say that if your drivers are very high mileage, so if you have people on the road who are driving a significant amount in comparison to their reimbursement, so 20,000, 30,000 miles, it's very possible and also very common that even if they do fall out of compliance for one of the reasons that we showed before, so their car's too old, too inexpensive, they might not see tax. And that's because when you compare it to the IRS standard rate, they're still in the clear. I mentioned earlier that the IRS standard rate sometimes overpays, right? Like if you drive a ton on the IRS standard rate and you're racking up miles, you are disproportionately increasing your payment the more you drive because your fixed costs don't actually go up that much the more you drive, right? Of course, you're putting depreciation, but they're not astronomically going up. But when you're using a variable only payment, they astronomically go up. So FAVR really helps to level set that. And then when you do this calculation, you probably aren't going to see tax at all. But that's why a really well-designed program, back to the original point, is so important, is because when you understand your mileage minimums, you understand your qualification, and you also understand what your industry standards are, you can build rates that effectively are designed to not seek tax, are designed appropriately so that you're never going to have these challenges. And of course, if you do have compliance challenges, we really want to make sure we're building things and solutions, and we have thresholds in place through policy to effectively adjust people through tiers. Every company is differently, and we'll talk a little bit about strategy to do that later in the presentation. But I do want to introduce you to our third and final vehicle reimbursement program type. This might be new to a couple folks. This is called a tax-free car allowance, or sometimes known as an accountable program, and it's associated with IRS Publication 463. So this is an alternative method of reimbursement, which allows companies to offer simple, flat allowances to drivers without the compliance regulations associated with more flexible, robust alternatives like FAVR. So this is eligible to be up to 100% tax-free relative to a driver's reported mileage. So let's take a step back and talk a little bit about what that means. So in this scenario, I could pay my drivers anything I want. I could give them $10,000 flat for the year. I could pay them $500 per month in a flat car allowance, which is very common. I could even use FAVR market rates. I could use FAVR reimbursement. But the difference is how they're taxed. The difference is that we assume they're out of FAVR compliance in how we tax them. That means we're always comparing them against the IRS standard equivalent at all times. Meaning I calculate their mileage, I multiply it times the IRS standard rate of 67 cents in 2024. It'll probably change next year and we'll do a different calculation. And then I compare it to what they actually got, what they actually took home on their tax-free car allowance. And only the difference is taxed. Only the difference is taxable, just like an out of a compliance FAVR program. So this is a lot more simple, right? It's a great option for companies that are struggling with FAVR compliance, right? So if you have a group of drivers who are perhaps high mileage, but their cars are way too old and the company doesn't mind that, the company doesn't want to put any thresholds in place that require newer vehicles, it's common. Some companies do require that. But if that's the case, this is a good option, right? The other option is when you're looking to lock a rate across a department or group, or and this is, I think, the best scenario really for when this should be used, is for executives looking to just erode their tax bill, right? A lot of the times executives don't hit the road too much, but they do have a pretty healthy driving benefit, or it could be, flat stipend, it could be within payroll. But for people who are really just looking to erode that tax bill, enrolling them in a tax-free car allowance allows them to do that really, really simply. Whereas your other road warriors, your field sales, your field merchandisers, your field service technicians being on FAVR makes a lot of sense because they could potentially, of course, have 100% tax-free reimbursement and are being paid very fairly based on their mileage, not over or under inflated. And I will mention, of course, FAVR is the only scenario where you can pay over the IRS standard rate, or its net equivalent, of course. All right. So there's a lot of information that we now have to put together. Again, it's all about pairing people to program fit. We want to be matching employees to the appropriate reimbursement options and using a standardized approach to make this super clear. So there's a couple things that we want to identify first in an ideal program. And I think it's fair to say that every company operates within a set of boundaries, and that typically is set by budget. So we have a budget. We know we can't pay over a certain amount, a very, very common threshold to operate within. The other one is, of course, industry and market standards. So what are your peers paying? What is the common vehicle to base your standard rate on? And then the other thing too is what is actually that real-time cost of driving? Like what does the data tell me is the cost of driving in, Idaho versus Omaha? And then, of course, when we're talking about selection of program and maintaining people on programs, we want to ask ourselves a couple questions. What does our historic compliance look like? Mileage. Do we want to standardize this based on bands or tiers or job types? What is the cost and benefit of keeping somebody on FAVR who might fall out of compliance, but might be within a job type that it makes sense to be reimbursed on that? And this is kind of a process we'll go through with all of our clients. And then lastly, rate creation. So of course, things like type of profile, any internal vehicle policies that we want to adjust, or insurance regulations to take into account. This will really help us build programs that help us achieve varying objectives, right? There's a lot of stakeholders involved, but we want to make sure that things are pretty streamlined. And then a lot of the time, if there is some savings associated with these programs, we have to decide how to split the savings, right? Is a company going to take home 50% and the driver's 50%? How do we make everybody really happy? And there's never one size fits all. Griffen, I want to ask you this. What do you think about mixing programs, right? If some jobs require less driving than others at an organization?
For sure. So mixing programs is definitely a great solution. We see a lot of hybrid approaches. They're very common and are a great way to accommodate different needs of drivers who have different behaviors. So, for example, we'll often see FAVR being used for very high mileage drivers, and then maybe CPM for some of those lower mileage drivers. And then maybe we'll throw a tax-free car allowance in there for your executive folks where you want maybe a richer benefit. So that's exactly what your reimbursement partner is here for, to allow you to build something a little bit more complex without having to absorb the administrative burden of doing so.
Great point. Yeah, great point. And the work shouldn't stop there on your partner's end. Once the program's up and running, as Griffen mentioned, there's some management elements to consider. So business reviews with your customer success manager are really key to program management. So while your employees are on the road every day, capturing mileage, submitting it for reimbursement, we want to make sure that those programs don't go stagnant month over month, that we're always keeping things running smoothly in the back end. So making sure that we're meeting to discuss your goals are going to be really important because it's going to help us reduce tax risk and, of course, increase your ROI, and then also make sure that your program is fair. So we want to measure against KPIs, program goals, review prior reimbursement program and vehicle profiles. We want to set goals for the next year financially, again, those budget constraints that we were discussing, and then review any changes to regulation that might impact us. And you should really trust your partner with this because effective management of FAVR should not stress you out by any means. It should make your life easier and should make everybody's life easier because they're getting a fair payment. And that's really a cornerstone of what we prioritize here. So some common KPIs that companies measure against on whether really their program is trending in the right direction. We talk about fit and pairing effectively is going to be number one, mileage minimums and trending mileage. So if you haven't noticed historically that your people are not going to hit your FAVR 5,000 mile mark, and your partner has not said that to you, and you haven't had a solution for that, it's something that you should consider, right? Mileage minimums is a really great way to determine whether you're going to get a strong ROI in your program. Other elements are compliance status. So if you can use the quarterly tax reports in the Cardata cloud, for example, to see where you're trending, even if you do tax annually, it's a good way to see where you stand. You also want to look at spend year to date and cost savings so far. So versus last year, how much tax savings you've had, where any gaps are in terms of what your goals were and where you are today. And then, of course, industry position versus your other companies in your industry. And you really want to use this data to benchmark and to ensure that you are playing where you want to play, right? You have an attractive benefit, or you're being really cost effective. And of course, your customer success manager can set this up with and for you, and establish really proactive outreach standards based on your key performance indicators and your goals so that they can manage these priorities for you. So I just want to show you a couple examples of how some companies reimburse. So this one's from pharma, medtech, and biomed. And this is just examples of this particular industry and how 4 companies have just configured their favor rates for their salespeople and on the road for work. This is as of April 2024. And it's really averaged across an entire driver population. Remember, everybody's different depending on their zip code, location, and driving frequency. But I just want to really note the range that we're seeing here. It all depends on the vehicle profile selection, the configuration, decisions, as well as what's suited for each company. But in general, you can see some trends with regards to this industry. As we click through, you can see that, of course, every company is a little bit different across a wide range of industries, construction, CPG, etc. And as you see this data at your annual review, and at request, you can decide where to play. All helpful in benchmarking.
Perfect. Thanks, Lee. So the top 5 challenges faced with other providers that we've heard from customers before transitioning to Cardata from an alternative provider are listed on this slide. So what we hear is unresponsive customer success managers. So not being able to get in touch with the folks who are helping set up your program and maintain it. Year-over-year cost spike. So that's where we see upsells that maybe aren't necessarily adding value to your program. Employee driver support delays. Your folks are out on the road and it's very important they get the help they need in the moment. And then lack of program evolution. So we're not seeing the program grow with changes in the economy, changes in the business, changes in their driving habits. And then finally, insufficient employee, driver, and administrator training. So, the key to a good program is getting started on the right foot. So ensuring that your folks on the road, as well as your folks who are going to be managing the program, have a very clear idea of how things are going to operate.
Awesome. Now, I want to just speak to how we're a little bit different at Cardata. We really use a fully managed approach. And what does that mean? Well, effectively, we pair proactive program management with effective KPIs and every tool you need the whole step of the way from your end-to-end reimbursement journey. So that means easy to use software, ranked highly on G2 for usability, but also, complete in-house employee support, right? We don't want you to have to take on any burden with this increased complexity of some perceived tax regulation, right? You shouldn't have to deal with that. That's really for us. And we want to make sure that your emails, your calls from your drivers are going to us, and that they feel really confident in the transparency of their program, why they're being paid that, and that they can trust to come to us for really great information and answers. And that's really the key difference in our business model. We do take a partnership approach to reduce your admin burden, where you can feel really confident with your program in our hands. And that's really because we lead with education. Seminars like this, for example, effective training, quick response times. We answer 80% of calls within 1 minute, to really keep employees engaged, which ultimately, as we mentioned earlier, keeps your compliance high, keeps your ROI high, and make sure that your people are happy. I'll leave you with a little bit of a transition study here. Aero Electronic made the switch to Cardata a couple years back because they were struggling with some of the challenges that we discussed today. So they had around 600 employees in North America. Their old vehicle reimbursement program lacked some clarity, and it really lacked support. They were confused. There were internal efficiency gaps. And then really they wanted to give a program that made sense, that was transparent, and that was really compatible with the dynamic business model and changing driver groups, right? They wanted to make sure they're pairing reimbursements to people effectively. So they said, we need a partner to do this. They effectively worked with Cardata to train, redesign, manage all their program tools, reporting, and direct driver payment through a FAVR reimbursement in Canada and a US FAVR program as well. So all really a standardized way to support drivers on the road. Arrow's employees now simply just log their mileage using the Cardata application, and we do the rest. So it's very streamlined. It has a really strong buy-in for everybody in the organization in ensuring that everything is fair and that people are happy. Reimbursements just make sense. Now, as we kind of close up today, just to summarize, I hope you took away some of these insights for the ins and outs of vehicle programs. I want to thank you all for your time and to remind everybody that, of course, every company is different. Your goals today might not be the same as your goals were yesterday, and your drivers' behaviors might not be the same as they were yesterday. But that's what we're here for, to build policy, to build thresholds, and to build technology that effectively enables you to manage this stuff appropriately. And if you leverage a true partnership, you'll make sure you get the right people paired to the right programs. Thank you so much for joining us. We will now move to questions in the chat. I see that the Q&A has a couple in here. Okay, I'll start with, is it better to group people in favor by job type or by mileage minimums? I love this question. I think that this is a really excellent question. I'll answer it multifold. First and foremost, mileage minimums are a really good qualifier in terms of tax compliance. Like it's really, that's the base level regulation for FAVR is that 5,000 mile mark. Everything else, as I mentioned earlier, sometimes comes out in the wash if you drive a lot, right? Like the more you drive from a tax perspective, you still might not see tax, but that mileage minimum is really key. So that's the important thing to consider if you're enrolling people on FAVR based on the goal to be 100% tax-free. Other companies might say, you know what? We want everybody who's a field sales rep to be on FAVR. That's what we want, right? That's the goal. And if we have a couple people who fall out of compliance, oh, well, we'll tax them. Other companies say, no, we're going to tier it. We're going to make sure that the low mileage people get cents per mile, the high mileage people get FAVR. And it really does come down to the importance of standardization versus cost savings for organizations. Of course, it's important to note that FAVR will course correct for mileage. Like if you drive less, you're not going to get reimbursed as much, right? And also, if you drive less, from a fixed perspective, you'll also get less depreciation, so you'll get reimbursed less, both fixed and variable. So it does course correct, but it's really about deciding as the company, like how much tax compliance matters. And if there's an element of like, look, it's okay if we lose a couple people to some taxability, then I would say that job type makes a lot of sense in terms of standardization and also getting buy-in for regulations. How similar are FAVR programs offered by different vendors? Great question. FAVR is an IRS program. They've given it to us, right, Griffen? They've given it to us. They said, here you go. You can facilitate it, and we are simply stewards of FAVR. So, differences will lie in the nuances of how the rates are created and, of course, how they're managed. The regulation is the regulation, but our business model strongly believes in understanding goals, updating rates effectively, and using our robust 25 years of knowledge about FAVR to make sure that your FAVR rates make sense. Of course, every company is going to have like small differences in the databases that they use and where they pull data from, which might change the rates, 10, 15% compared to each other. But that's why it's really important to understand how rates are configured so that you can make adjustments as necessary if that standardization between a vendor switch is super important. All in all, very similar. It's just going to be some nuances of how we effectively manage things like your compliance and your cost goals. We're using the same tools, but we're doing it effectively differently. Awesome. I don't see any more questions in the chat. Thank you so much, everybody, for joining us. I will leave it open for a couple more minutes if anybody has any final questions. But again, thank you so much for joining us. I hope you learned a couple of things today. Appreciate everybody taking the time.
Thank you so much.